It began on a quiet Sunday evening. A single investment bank, one that didn't take deposits, operate branches, or serve ordinary customers, collapsed under the weight of its own risks. And yet, within hours, markets from Tokyo to New York convulsed. Trillions of dollars vanished from global balance sheets. Governments scrambled. Banks froze lending. Companies halted hiring. It was the moment modern capitalism revealed its greatest paradox, that the failure of one obscure institution could threaten the entire world economy. This is the story of how a single bank crash reshaped modern capitalism, and why the shockwaves still define the systems we depend on today. To understand the collapse, we need to step back to the late 20th century, when deregulation became the dominant ideology in Western finance. In the US and Europe, governments gradually dismantled the barriers that had long separated stable, commercial banking from high-risk investment banking. With these walls down, debt grew cheaper. Exotic financial instruments called derivatives exploded in popularity. Banks, once regional or national players, transformed into global conglomerates, becoming far larger and far more interconnected than ever before in history. For nearly 2 decades, the world celebrated this new era of finance. Global markets boomed. Credit surged across continents, fueling growth and consumption. Property prices soared, making homeowners feel wealthy. It seemed like a golden age. But beneath this glittering surface, enormous risks were accumulating, and seen by most. At the heart of this hidden danger were subprime mortgages, loans made to borrowers with poor credit, meaning they had a high risk of default. These risky loans were not kept on the bank's books. Instead, they were packaged together, sliced up, and sold as sophisticated financial products known as mortgage-backed securities. On paper, these products looked incredibly safe. The major credit rating agencies gave them top-tier ratings, signaling they were as secure as government bonds. But this was a mirage. They carried a hidden, systemic fragility. Banks, hungry for profit, leveraged themselves to an astonishing degree, sometimes borrowing $30 or even $40 for every $1 of their own capital. This meant that even a small decline in the value of their assets could wipe them out entirely. Still, confidence remained unshakably high. The system appeared unstoppable, a perpetual motion machine of wealth creation. That is, until one institution finally lost the ability to pretend everything was fine. In September 2008, Lehman Brothers, one of the oldest and most respected investment banks in America, ran out of time. For months, it had been desperately trying to raise capital to cover its losses. But it was too late. Investors had lost trust. Other banks, its counterparties, pulled away, refusing to do business. On September 15th, after a frantic weekend of failed negotiations, the bank filed for bankruptcy. It was the largest bankruptcy filing in U.S. history. What followed was an economic shockwave unlike anything seen in generations. The very plumbing of the global financial system seized up. Money markets, where corporations get short-term loans to pay for daily operations, froze solid. Banks, terrified of who might fail next, stopped lending to each other. Global trade stalled as companies could no longer get the financing needed to ship goods. Stock markets around the world plummeted at a historic speed. Governments faced a terrifying question: should they let the market correct itself, a painful but necessary cleansing? Or should they intervene to save the very architecture of modern capitalism from its own self-destructs? The choice was made in a matter of days. Around the world, major banks were rescued, nationalized, or guaranteed by governments using taxpayer money. Central banks, led by the U.S. Federal Reserve, coordinated to slash interest rates to near zero. The financial world that emerged from those frantic weeks was nothing like the one that existed before. The collapse forced regulators, economists, and governments to confront a new and uncomfortable reality: major financial institutions had become too big and too interconnected to fail. The failure of one could trigger a domino effect that would destroy the entire economy. From the ashes of this crisis, several structural shifts emerged that still shape our world today. First was the rise of the too big to fail policy. To prevent another cascading collapse, governments introduced a raft of new rules. They mandated higher capital requirements, forcing banks to hold more of a cushion against losses. They implemented annual stress tests to see if banks could survive another crisis. They required banks to create living wills, detailed plans for how they could be safely wound down in case of failure. The goal was simple: make the system more resilient. Second, central banks became the ultimate guardians of global markets. Before the crash, their main job was to adjust interest rates to manage inflation and employment. After the crash, they took on an entirely new, and much more powerful, role. They started injecting trillions of dollars of liquidity directly into the financial system by buying government bonds and those same mortgage-backed securities that caused the crisis. This policy, known as quantitative easing, reshaped everything, from stock prices to housing markets to the cost of government debt. Third, we entered a new era of ultra-low interest rates and cheap money. To stabilize the economy and encourage borrowing, central banks slashed rates to the floor. This had a profound, and perhaps unintentional, consequence. It fueled a decade of cheap credit, record-breaking stock market gains, and rising household debt. Capitalism itself became dependent on these low borrowing costs, fundamentally changing how businesses invested, how governments spent, and how ordinary people lived their lives. Fourth, financial risk came under intense new surveillance. Regulators introduced new global standards, like the Basel III Accords, designed to track and contain systemic threats before they could spiral out of control. Financial institutions became subject to intense reporting and oversight. These measures also revealed just how deeply modern economies rely on a stable, functioning banking system. And finally, public trust in financial institutions collapsed. The crisis exposed reckless speculation, deep-seated conflicts of interest, and catastrophic failures of governance at the highest levels of finance. Trust, once the invisible backbone of banking, was fractured. For millions of people, the crash marked the moment capitalism began to feel rigged, a system where the public absorbed the losses while the very institutions that caused the crisis were rescued and their executives walked away wealthy. More than a decade later, the legacy of that single bank's collapse still defines our global economy. Interest rates remained at historic lows for years, only recently rising. Governments around the world accumulated massive debts to stabilize their economies. Central banks are now deeply intertwined with the fate of stock and housing markets. This environment of broken trust and cheap money also fueled new movements. Financial technology, or fintech, surged. Cryptocurrencies rose in popularity, partly driven by a deep-seated desire for an alternative to traditional finance. A new generation grew up skeptical of old economic promises, watching wages stagnate while asset prices soared to the moon. And despite all the new regulations, the financial system remains highly complex and deeply connected. A shock in one part of the world can still trigger global tremors. The 2008 crash didn't end capitalism, but it exposed its modern vulnerabilities and forced a dramatic reset. In the end, the collapse of one bank did not break the system. It revealed it. It showed us just how complex, fragile, and interwoven global finance had become. It proved that modern capitalism relies on something intangible: confidence. Confidence in banks, in governments, in markets, and in the promise of stability. The 2008 crash reshaped that confidence forever. It pushed governments to intervene on a scale never seen before, transformed central banks into permanent market stabilizers, rewrote the rulebook of finance, and fundamentally changed the psychology of investors, consumers, and policymakers. Today, when we look at our economies, at interest rates, asset values, government debt, and the rise of alternative financial systems, we are seeing the long shadow of that single, defining moment. One bank's failure changed how the world understands risk, money, and power. And in doing so, it reshaped the architecture of modern capitalism quietly, permanently, and everywhere. When the bank collapsed, most people thought the fallout would stay local. I mean, a mid-sized bank failing, it happens, Capitalism has always had this idea of creative destruction built into it. Some things fail so new things can grow. It's supposed to be healthy, but this time was different. This time, the world changed forever. It all started with political panic. Governments, still terrified by the ghosts of past recessions, didn't just act, they overreacted. What should have been a careful, measured response turned into a full-blown political circus. We saw emergency meetings late into the night, grim-faced officials holding midnight press conferences, and bold promises that no depositor will lose a single dollar. Then, they opened the floodgates, unleashing a tidal wave of cash into the system. The message couldn't have been clearer. We will save the system, no matter the cost. And right there, in that moment of panic, a quiet deal was made. Then written rules of capitalism were torn up and rewritten. This was the dawn of the age of moral hazard. The funny thing is, the bank that started it all wasn't even that big. It wasn't one of the giants, but the government's massive reaction sent a signal, an unintended one, that echoed through every boardroom. If the collapse of this one medium-sized bank could trigger such an aggressive, no-holds-barred intervention, then couldn't any company argue it was just as important? And so they did. Suddenly, everyone was systemically important. Companies started lobbying, arguing they were critical employers in a key district, essential for national security, the backbone of American innovation, or the key to consumer confidence. A whole new category was born, too small to fail. Economy. Capitalism, which was once a brutal arena of competition where only the strong survive, became a game of political influence and lobbying power. Failure was no longer an economic event. It became a negotiation. This crisis also created new superpowers, the central banks. To stop the bleeding, institutions like the Federal Reserve had to do things they once considered taboo. They started buying up massive amounts of assets, offering sweeping financial guarantees, and experimenting with bizarre interest rate policies. Just a generation before, central bankers were seen as quiet, technical experts who managed the plumbing of the economy. After the crash, they became its chief architects. Their job description exploded. Suddenly, they were responsible for stabilizing markets, preventing recessions, maintaining full employment, fighting deflation, and ensuring liquidity, basically doing everything possible to stop capitalism from running its natural, sometimes painful course. Markets learned a very dangerous lesson. Bad news is good news. Every time the system wobbled, it wasn't a signal to be cautious, it was an invitation for more intervention, more easy money. Risk-taking went through the roof. Asset prices inflated into massive bubbles. Capitalism became an addict, and the central banks were its dealer. This led to the quiet birth of something I call zero consequences capitalism. Think about it. For centuries, the market was simple. It rewarded careful decisions and punished reckless ones. If you took a stupid risk and lost, you paid the price. But the government's response to this one bank failure completely flipped that logic on its head. Investors and executives everywhere had a revelation. If my losses get covered by the public but my gains are all mine to keep, then the most rational thing to do is to take the biggest, wildest risks I possibly can. It's a heads I win, tails you lose situation. Corporate boards immediately changed their strategies. They took on more debt, chased more speculative ventures, and focused on clever financial engineering instead of genuine innovation. The original crash didn't just cause a panic, it fundamentally rewired the incentive structure of the entire global economy. That's why economists don't just call it a collapse. They call it a pivot point, a hinge in economic history where everything changed. The final piece of the puzzle was globalization. The flood of cheap money that governments printed had to go somewhere. Capital started zipping across borders at lightning speed, searching for any place it could find a decent return. This turbocharged globalization. Supply chains that used to be local or national stretched across entire continents. Companies outsourced everything: manufacturing, customer service, even research and development. On the surface, it looked like a miracle of efficiency. Prices for consumer goods plummeted, but this efficiency came at a huge cost: fragility. The world economy became a single hyper-connected machine. It was incredibly efficient, but also incredibly delicate. A small disruption in one tiny part of the world, a factory shutdown, a shipping delay, a political crisis could now send shockwaves across the entire globe. The bank crash didn't invent globalization, but it created the supercharged, fragile version we live with today. And the story doesn't end there. This is really just the beginning. This single event, this one bank failure, and the panicked reaction to it, planted the seeds for so many of the problems we face today. It's the reason inequality exploded, with asset owners getting richer while wages for everyone else stagnated. It's why governments seem to have lost all leverage over massive corporations. It's how giant tech companies quietly became the new shadow banks, operating outside the traditional rules. And most frighteningly, it's how the seeds of the next, even bigger crisis were sown. If you want to understand how we got here, and where we might be going next, stick around for the next part of this story. Thanks for watching, and don't forget to subscribe.